Study Session 1. Nature of Accounting. Introduction. Accounting, or accountancy, like taxation, has been a function of organized society throughout history. Accounting is the recording, reporting and, sometimes, interpretation of all the financial, money value, transactions and resources of individuals, enterprises, and other formal organizations, accounting entities. The main branches of accounting are financial accounting and management accounting. Financial accounting has as its principal role, the keeping of accurate records of the economy. In this study session, you will be exposed to the meaning and nature of accounting. This study session will look at the development of accounting as a discipline and the quality of accounting information, as well as identifies those good qualities accounting information should possess. The nature of accounting. Accounting as a discipline is a language of business. It can be described as the system of recording, summarizing, and analyzing a business organization's financial transactions. Different people define accounting according to their understanding of the term. To some people, it simply means how to keep records of income and expenditure, while to some others it means how to check fraud or how to know if the organization is making profit or loss. From the above, it is discovered that accounting is a universal language to both individuals and corporate organizations, which practice accounting the way they understand the definitions. According to the American Institute of Certified Public Accountants, AICPA, accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of a financial character, and interpreting the result thereof. AICPA, 1961. Who is an accountant? An accountant is one who observes economic activities, records the observation in accounting language in the prescribed books, analyzes this recording, interprets his analysis, and prepares a report to all users of accounting information. In the process of doing this job, the accounting profession has recognized that the accountant requires a helper who will do the initial job of observing the economic activities and recording them into the appropriate book of accounts. Development of accounting as a discipline. The modern science or art of bookkeeping and accounting double entry was fully in operation after a Franciscan monk, Luca Pacioli, an Italian-born, published his work in 1949 titled Summa Arithmetic, Geometry, and Proportion. It is this publication that earns Luca Pacioli the accolade Father of Accounting. It was in this publication that expands the double entry principle. The book that was basically an algebra text devoted a chapter to expounding the principle of double entry system or principle, which still today forms the basics of all accounting records. The significance of Pacioli's work was therefore that it systematically popularized a principle, which had probably been only haphazardly applied. This was the foundation on which all subsequent development in accounting. Development of accounting education in Nigeria. There have been arguments on how best to train accountants in Nigeria and other Commonwealth countries that embrace the British system of training. In the past, people believed that the accountancy profession should not be studied in the universities, rather people should be articleship, apprenticeship, that are learning the art and become perfect in it after several of years, and then you can raise to the highest position in the near future. It is from these that some professional accounting bodies were set up, such as the Institute of Chartered Accountants of England and Wales, ICAEW, Association of Chartered Accountants, etc. These accounting professional bodies was to shorten the period of articleship if they passed their prescribed examination, but did not rule out that the best way of training accountant is through articleship. As of then, the basic rule for these professional bodies is that you must undergo an articleship under an accountant, before you are allowed to take the professional exam. Training of accountants in Nigeria. The training of accountants in Nigeria followed the British system that was our colonial masters. The professional bodies that are responsible for the training of professional accountants in Nigeria are briefly discussed. Institute of Chartered Accounting of Nigeria, ICAN. In 1965 the Art of Parliament established the Institute of Chartered Accountants of Nigeria, ICAN. Association of National Accountants of Nigeria, INAN. In 1979 a second professional accounting body called the Association of National Accountants of Nigeria, ANAN, was founded and chartered by Decrees No. 76 of 1993. Analyze the users of accounting information and their needs. Accounting has always been described as the language of business, and this underscores its importance. It is also common practice for books on accounting to employ business situations as the basis for exposing the principle of the subject. Many individuals and corporate bodies utilize accounting information to make wise decisions on financial matters affecting them. Quality of accounting information. We have mentioned numerous interest groups that use accounting information for different decision-making. This tells us that accounting information must be prepared with extreme care so as to satisfy the user's needs. This also underscores the need for the requirement of an accountant because of the strategic importance of the information he generates. Limitations of financial accounting. Financial accounting is a statutory requirement and the format and disclosure are well spelled out by Company and Allied Matters Decree of 2004 and International Financial Reporting Standards, IFRS, as pronounced and adopted by Financial Reporting Councils of Nigeria, FRCN. Some of the limitations, which hinder the usefulness of accounting information, are discussed below. 1. The statements are published once a year and mainly at the end of the financial year. This means that the users of accounting information must wait for 12 months till the end of the financial year before recording the information required to evaluate the managerial performance for the period. 2. The statutory requirement of the financial statement is historical in nature. 3. Monetary value is placed on items. It is not possible to reflect the value of staff, customers or competitive strength of the organization compared with others in the same industry in a set of publishes financial statements. 4. The presence of inflation is not taken care of in our financial statement in Nigeria and the level of inflation is increasing in Nigeria every day. This shows that the current and non-current assets and liabilities are either overvalued or undervalued in the financial statement due to the presence of inflation in Nigeria. Study Session 2. Bookkeeping and Source Document. Introduction. In this study session, you will learn bookkeeping as an essential part of accounting that helps in providing a record for all transactions. It also helps to determine the profit of any business. We will be looking at the differences between bookkeeping and accounting and review various books that are kept by the booker as well as the problem of bookkeeping. You will learn what source document is and the various source document in accounting, like the invoice, credit note, debit note, receipt, etc. The concept of bookkeeping. Bookkeeping is the actual systematic recording of daily transactions in the appropriate books. It is the recording, on a day-to-day basis of the financial transactions and information pertaining to a business. It is concerned with ensuring that records of those individual financial transactions are accurate, up-to-date, and comprehensive. Qualities of a bookkeeper. The quality of a good bookkeeper is summarized below. 1. Must be an honest person since it deals with things that have monetary value. 2. Must be a careful person so as to avoid the wrong recording of information. 3. Must be good in the English language in terms of writing and speaking. 4. Must be good in mathematics as the job involves addition, subtraction, division, and multiplication. Bookkeeping versus accounting. Bookkeeping is responsible for the recording of financial transactions, accounting is responsible for interpreting, classifying, analyzing, reporting, and summarizing financial data. Accounting involves interpreting and analyzing data. Bookkeeping does not involve interpreting and analyzing data. Bookkeeping is the process of recording, in chronological order, the daily transactions of a business entity. Accounting is an information system that includes the process of recording, classifying, summarizing, reporting, analyzing, and interpreting the financial condition and performance of a business in order to communicate it to stakeholders for decision-making. Concept of source document. In bookkeeping, there is a rule that demands that there must be objective evidence for any information we record in the accounting book. A source document describes all the basic facts of the transaction such as the amount of the transaction to which the transaction was made, the purpose of the transaction, and the date of the transaction. They include invoices, bank tellers, receipts, checks, credit notes, and debit notes. Various source documents. Invoice. This is a written order giving the authorization to purchase goods or services from a supplier. The seller, supplier, prepares the invoice and sends it with goods to the buyer, or customer. Credit note. This is evidence that goods have been returned by the customer to the supplier, probably because the goods were damaged or because they were not in accordance with the specification. It can also be defined as a memorandum, memo, document issued by a seller to a buyer. The seller usually issues a credit memo for the same or lower amount than the invoice, and then repays the money to the buyer or sets it off against a balance due from other transactions. Debit note. This is evidence that goods have been returned to the supplier by the customer. It is sent together with the goods returned by the customers to the supplier. It can also be defined as a commercial document issued by a buyer to a seller as a means of formally requesting a credit note. Checks. This is a standing instrument to the bank to pay a certain amount of money to the person or company the name appears on the check. It can also be defined as an important negotiable instrument, which can be transferred by mere hand delivery. A check is used to make safe and convenient payments. It is less risky and the danger of loss is minimized. There are various types of checks and they include bearer check, order check, uncrossed, open check, cross check, anti-dated check, post-dated check, stale check. Bank teller. This is evidence that money has been deposited into a bank account. The transaction here is between the banker and the person paying the money, who may be the account holder or some other person directed by the account holder to pay the money. Receipt. A receipt is a document issued by the seller to the buyer to show that he paid a certain amount of money for an item purchased. It is also seen as documentation that payment has been made to finalize a sale. It serves as proof of ownership in most cases. It lists goods or services, prices, credits, discounts, taxes, the total amount paid, and the method of payment. Importance of bookkeeping. Proper bookkeeping will help a business identify where there is overspending and eventually lead to a reduction. Accurate bookkeeping allows you to see whether or not your business is actually making a profit. It is surprising how often business owners fail to keep track of this, but it is obviously extremely important. Bookkeeping always helps a business owner to have a greater understanding of how much progress the business has made. Bookkeeping may seem a burden when you are trying to grow your business, but it is essential if you are to not only survive but also prosper in today's tough economic climate. A proper bookkeeping system is essential to any business, whether big or small, in order to manage its daily functions and keeps the business running successfully. For any successful business, the main obligation is to maximize profits, minimize any loss, and at the same time maintain its position as a responsible entity within the society. A business that does not have a proper bookkeeping system is like a blindfolded driver who can easily cause an accident. Study Session 3. Basic Accounting Concept and Convention. Introduction. The main thrust of accounting is the measurement of value, especially in relation to capital and income. These two factors are related in different ways. Capital is used to generate income, and this ability to generate income makes capital efficient. The dependent relationship between these two presents a problem because income is not a precise concept in accounting, and this brings about measurement problems. This study session intends to teach you all about accounting concepts. It will also explain to you how to identify the problem of accounting concept and convention, as well as the concept of trial balance. Accounting concepts and conventions. Accounting concepts and conventions evolved as a result of information needed by the users of accounting information, which became conflicting over time because of different methodologies or procedures used in its preparation. Accounting concepts and conventions could be defined as ground or laid down rules of accounting that should be followed in the preparation of financial statements. You will recall that when applying the double entry principle, every credit entry has a corresponding debit entry, and also every debit entry has a corresponding credit entry. Therefore, the total of all the debits recorded in the account should equal the total of all the credits. The trial balance establishes the arithmetic accuracy of the entries posed to different ledgers. Accounting concepts and conventions. These are rules, regulations, or principles set down to guide the preparation and presentation of financial statements or reports. Problems affecting accounting concepts and conventions. There are many problems arising from the application of these laid-down principles. They include: 1. Problem of objectivity. 2. Problem of consistency. 3. Problem of materiality. 4. Problem of prudence. 5. Problem of realization. 6. Problem of going concern concept. 7. Problem of measurement. 1. The problem of objectivity. There are many aspects of accounting that ensures that objectivity cannot be universally applicable in the preparation of accounts. For example, the different value of the charge rate of depreciation by accountants. 2. The problem of consistency. Most times, because the method employed in treating certain items may vary from time to time, making the concept of consistency to be applied more and more rigid. This problem can also be seen in the short-term manipulation of reported results. 3. Problem of materiality. In materiality, deciding what is and what is not material is a problem, and this concept does not apply while recording cash transactions, thereby leading to small amounts being omitted from the cash book on the ground that they are not material. Concepts and conventions. 4. Problem of prudence. Conservatism to an excess degree will result in the creation of secret reserves. 5. Problem of realization. This problem arises in the case of revenue recognition and the valuation of closing stock, whereby the general principle for valuation of inventory is to take the lower of cost and net realizable value. 6. Problem of going concern concepts. This arises whereby sales are made but the customers with the notion of the perpetual existence of the firm in mind might delay the payment of the item acquired, thereby leaving the firm with no cash, and this gradually leads to the dwindling of the business. 7. Problem of money measurement. Transactions that cannot be expressed in money terms do not find a place in the books of account, though they might be useful in business. The trial balance. A trial balance is defined as the list of balances extracted from different ledgers primarily to show the arithmetic accuracy of accounting postings. This, therefore, means that if accounting entries are properly posted and summed up, both sides of the trial balance are expected to be equal in sum. Importance of trial balance. The importance of trial balance includes the following. 1. It is the easiest way of verifying the arithmetical accuracy of entries posted to the ledger. If the trial balances agree, it is an indication that the accounts are correctly drawn up, but this may not be conclusive proof. 2. It aids in the preparation of the final account. Without a proper written-up trial balance, it might be very difficult to prepare an accurate financial statement. Procedure of preparing trial balance. To draw up the trial balance of these transactions, you are expected to journalize the opening balances brought forward. In the absence of the opening balances, there will be no need to journalize any items. You can simply journalize the opening balances of this question by drawing up 3 columns, one for the particular and the other 2 for the debit and credit entries. The procedure of preparing trial balance. If you peruse the table above carefully, you will discover that the capital item is featuring for the very first time and its figure is posted to the credit column of the journal. The capital figure is ascertained by applying the accounting equation. If you can recall, the accounting equation is given by asset equals liability plus capital. The items whose balances are on the debit column of the journal are the assets, while the items whose balance appeared on the credit column of the journal are the liabilities and capital. In this illustration, capital is the difference between both sides. Study Session 4. Correction of accounting errors. Introduction. Organizations are established with a motive. This motive can be financial or otherwise. To assess the organization's performance as regards achieving its motive, financial statements even in their simplest form should be prepared. In this study session, you will learn about the general-purpose financial statements as well as the users of the financial statement. Error in accounting. Accounting errors are mistakes committed while recording transactions, posting into accounts, and balancing accounts by persons responsible for recording and maintaining the accounts of the business organization. There are various types of errors in accounting. There are some that can prevent both sides of the trial balance from agreeing, that would affect the trial balance, and some still that would not prevent both sides of the trial balance from agreement. It is in tandem with this, we can state that the agreement of both sides of the trial balance does not imply the absence of errors in accounting records. Errors that do not affect trial balance and their corrections. The error of omission. Accountants may sometimes in error omit transactions completely or record them partially. This type of accounting error is called error of omission. When an accounting record is partially omitted, it could lead to the disagreement of 2 columns of a trial balance. More partially omitted accounting errors would be discussed when considering errors that can affect the trial balance. The error of commission. The errors that occurred when transactions are posted to the wrong account within the correct class of account are called errors of commission. The error of principal. An error of principal is said to have been committed when a transaction of a particular class of account is posted to another class of account. For example, if expenses on the maintenance of the vehicle are posted into the fixed asset account. The error of original entry. This is the error as the result of recording an incorrect amount in the subsidiary account and the same incorrect amount is correctly posted to the individual accounts. It could also be referred to as transposition error. The error of complete reversal of entries. In this type of error, the correct amount is posted to the correct set of accounts but on the wrong side. For example, the account that should be debited is credited and the corresponding is debited. Errors that do not affect trial balance and their corrections. 1. Error of omission. 2. Error of commission. 3. Error of principal. 4. Error of original entry. 5. Compensating errors. 6. Complete reversal of entry. Errors that affect trial balance. Like it has been pointed out, these errors would make the 2 columns of the trial balance disagree. These types of errors normally occurred on one side of the account. These errors span from partial reversal of posting, single entries and wrong totally affected in one side of the account. Rectifying these types requires the use of a suspense account. The suspense account is an account that accommodates any differences in the trial balance pending when it is rectified. A suspense account is open to make the two sides of the trial balance equal temporarily. The reason for the error has to be investigated. The suspense account would fizzle out if the source of difference is found out, otherwise, it would be featured in the statement of financial position as a current asset or liability. General Purpose Financial Statement. A general purpose financial statement is a financial statement that provides information about the financial performance, financial position, cash position as well as overall health of a business to a variety of users for informed decision-making. It can also be described as a statement intended to meet the needs of users who are not in a position to require an entity to prepare reports tailored to their particular information needs. That is, they are financial statements prepared in accordance with the applicable financial reporting framework designed to meet the common information needs of a wide range of users. It will normally comprise of the statement of profit or loss, income statement, statement of financial position, balance sheet, statement of cash flows, statement of changes in equity, and notes to the account. Users of financial statement: management, prospective investors, financial analyst, suppliers of fund, employees, government, public, competitors. Elements of a financial statement. 1. Assets, resources controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. Examples include land and building, plant and machinery. 2. Liabilities, present obligations of an entity arising from past events, the settlement of which is expected to result in an outflow of economic benefits from the reporting entity. Examples include bank overdraft, account payable, creditors. 3. Income, increases in economic benefits in the form of inflows or improvement of assets, or decrease in liabilities that lead to an increase in equity, other than increases based on owners' contributions. Income would generally comprise revenue and gains. 4. Expenses, decreases in economic benefits in the form of outflows or reduction of assets, or incurrence of / increases in liabilities that lead to a decrease in equity, other than decreases caused by distributions to owners. 5. Equity is assets with fewer liabilities, commonly known as shareholders' funds. For a sole proprietor, a shareholders' fund is basically made up of capital and profit. It is what belongs to the owners after all and sundry have been settled. For a company, this is more complex. Shareholders' fund comprises ordinary shares, retained earnings, and general reserves. Elements of a financial statement. There are 5 elements of a financial statement. They are assets, liabilities, expenses, incomes, and equity. They are the smallest identifiable unit of items contained in a financial statement. Contents of financial statements. Now, under the dispensation of International Financial Reporting Standards, IFRSs, with respect to the following specific standards, IAS 1, IAS 7, IAS 27, IFRS 1, we have the following. Statement of financial position. Statement of profit or loss and other comprehensive income. Statement of changes in equity. Statement of cash flows. Notes to financial statements comprising statement of compliance with IFRSs, a summary of accounting policies, and other explanatory notes. Study Session 5. Preparation of simple statement of profit or loss and statement of financial position. Introduction. One area of performance that stakeholders are usually interested in is financial performance. This specific performance can be seen by preparing the statement of profit or loss. Let us now consider those things that make up the statement of profit or loss. In this session, you will be introduced to the profit or loss accounting and statement of financial position. The statement of profit or loss. Initially, it was referred to as a trading, profit, and loss account. However, it is now known as the statement of profit and loss and other comprehensive income. Other comprehensive income sections will be taught in later years. Though the name was changed, the purpose still remains. Therefore, we can say that a statement of profit or loss is a statement to show the financial performance of a business. In line with the periodicity concept, this statement is usually prepared annually, 12 calendar months. The statement of profit or loss. Trading account. Trading in accounting refers to the selling and buying of goods. The trading accounting is prepared to determine the gross profit on trading. It can also be used to determine the effectiveness of the pricing policy of a business. Turnover. By turnover, we mean sales. This can be cash or credit sales. When both are added up, we arrive at total sales. This represents how much we have been able to sell to third parties. In a simple form, it can be gotten by multiplying the selling price by the quantity sold. It is also possible that after sales, customers may choose to return some of the goods earlier sold to them due to various reasons. Cost of sales, this represents the cost incurred on the goods that have been sold. It comprises the cost of goods available for sale and the closing inventory. Closing inventory is the remainder of goods yet to be sold at the end of the accounting period. The cost of sales relates to all costs incurred and is traceable directly to sales. Gross profit, this is the difference between net sales/turnover and the cost of sales. When net sales are greater than the cost of sales, we have a profit, but if the reverse is the case, we have a loss. Profit and loss account. This is the account that shows the net profit or loss of a business. It is a continuation of the trading account that deals specifically with revenue items, expenses and incomes. Based on the matching concept, incomes derived are matched against the expenses incurred in getting them. Thus, items of accruals and prepayments are adjusted. Operating expenses. Operating expense can be described as a revenue item. It is an expense whose benefits are exhausted within one accounting period. It is any expense incurred in running and maintaining the operating capacity of a business. They are broadly grouped into three headings, viz. 1. Administrative. 2. Selling and distribution, and 3. Financial expenses. Administrative expenses. These are expenses, though indirectly related to sales, are directly related to administrative, office, functions in an organization. They are also known as administrative overheads. They include wages and salaries, depreciation of office equipment, salaries of administrative staff, telephone charges, and bad debt. Others include postage and stationery, legal fees, and any other shared expense apportioned to the administration. Selling and distribution expenses. These are expenses incurred to put goods in a saleable condition as well as cater for its distribution from warehouse to point of sale. They include 1. Depreciation of selling van. 2. Salesman salaries. 3. Advertisement. 4. Carriage outward, this is different from carriage inward, etc. Financial expenses. These are revenue costs incurred in raising funds for the business. They include 1. Expenses on loan. 2. Interest on loan. 3. Bank charges and the likes. Other incomes. These are other incomes derived from sources other than the main business of the organization. There are usually gains from past investments or transactions. Examples are 1. Discount received. 2. Rent received. 3. Bad debt recovered. 4. Profit on the sales of assets, etc. These incomes will normally be added to gross profit. Net profit and loss. This is the difference between total income, gross profit plus other incomes, and total expenses. When total income is greater than total expenses, we have a profit, but if the reverse is the case, we have a loss. For a sole trader, the net profit represents his/her reward for trading and is therefore transferred to the capital account. For partnership, it is shared amongst the partners in the profit-sharing ratio under what is known as the appropriation account. For a company, the profit is usually distributed between the government, tax, shareholders, dividend, and the company, retained earnings. NB, the profit or loss account is a continuation of the trading account. Statement of financial position. This was formerly known as the balance sheet. Just like the statement of profit or loss, this statement is prepared with respect to the periodicity concept. It is a statement that deals with capital items. Any ledger that has not been closed to the profit or loss account will be closed to the statement of financial position. The statement of financial position is an organized listing of assets, liabilities, and equity at the end of an accounting year. It provides a snapshot of the financial position of the business as at the close of the year. Let us quickly state that the statement of financial position is not an account. It is merely a statement of ledger balances. In layman's terms, it is simply a statement of the balances brought down and remaining in the books at the end of the year. Assets are recorded on the right-hand side of the statement of financial position while equity, liabilities, is on the left-hand side. Assets. These represent resources controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. We have various classifications for assets. Let us look at some of them. Assets. 1. Non-current assets. These are assets acquired and held permanently in the business and are used for the purpose of earning profits. They have a useful life of more than 1 year. They are not acquired for resale land and buildings, Machinery, furniture, and fixtures are some examples of these assets. 2. Current assets, also known as short-term assets or circulation. These types of assets do not span more than one accounting year. They are needed for working capital. Examples include cash, account receivable, debtors, bills receivable, prepayments, etc. 3. Tangible assets, assets that can be seen and felt with hands, e.g. plant and equipment, furniture. 4. Intangible assets, the opposite of tangible. They cannot be seen or touched. Goodwill, patents, copyrights are examples of intangible assets. 5. Fictitious assets, as the name implies, they are not real assets in the true sense but have attributes that make them be described as assets. They do not have any realizable value to an organization. A good example is preliminary expenses. 6. Wasting assets, assets that are consumed in the process of operation, for example mines and quarries. Liabilities. These represent obligations owed by a business. They are present obligations of an entity arising from past events, the settlement of which is expected to result in an outflow of economic benefits from the reporting entity. We have two broad groups. 1. Non-current liabilities. These are obligations that fall due after more than one accounting year. A vivid example is debenture stock. 2. Current liabilities. Obligations that fall due within one accounting year are termed current liabilities. Equity. This represents the ownership claim of the business. From the position of a sole trader, it is the summation of net capital, opening capital plus additional capital minus drawings, and net profit. From the position of a company, this represents shareholders' fund and is derived by summing ordinary share capital plus retained earnings and general reserves. Study Session 6. Bank Reconciliation Statement. Introduction. Every business entity has reasons for maintaining bank accounts. These ranges from saving the excess above the amount that is immediately needed on a daily basis to avoiding misuse of financial resources by those whose custody these resources are maintained. An entity that maintained a bank account would likely keep a double-column cash book, so as to be able to record transactions affected by check and physical cash. To this extent, the bank statement ought to have similar records as the bank columns of the double columns cash book, though in the opposite direction. This study session will deal with bank reconciliation statements. Bank reconciliation statement. A bank reconciliation statement is a statement prepared to reconcile the differences that exist between the bank columns of a cash book and the bank statement at any given date. The reasons for the difference. 1. Unpresented check. When payments are made by checks, the bookkeeper of the firm issuing these instruments would immediately post these transactions to the credit side of the bank column of the cash book. The recipients of these instruments many a time would not have taken these instruments to the bank for immediate payment. 2. Uncredited check. Checks received from customers would have been dully lodged in the bank by the staff of the firm receiving the checks, and the bank column of the cash book is debited to the tune of the amount on the checks. And this transaction would increase the bank column of the cash book. 3. Direct lodgement. Sometimes, the debtors or the customers deposit the money directly into the firm's bank account. This lodgement is not made known to the firm until the firm received the bank statement. Remember, the bank account of the firm would have been credited immediately such lodgement is done. This transaction could make the bank statement balance higher. 4. Bank charges. The bank makes some charges to accounts of its customers for the services enjoyed by the customers. Many times, the customers of the bank would be unaware until a future date when they are intimated of such transaction either through personal contact or in the bank statement. The transaction can only be recorded in the cash book of the firm upon the receiving of bank intimation or statement. 5. Interest and dividend received by the bank. The interest on debentures or dividends on shares held by the account holder is sometimes directly deposited by the company through electronic clearing system, ECS. The firm would not be aware of this information till it receives the bank statement. 6. Standing order. Many times, some customers of banks stitched standing instruction to get certain expenses paid on their behalf. For example, telephone bills, rent, insurance premium, taxes, etc. These expenses are directly paid by the bank and debited to the firm's account immediately after their payment. 7. Dishonor of checks/bill discounted. If a check deposited by the firm or bill receivable discounted with the bank is dishonored, the same is debited to the firm's account by the bank. But the firm records the same when it receives the information from the bank. As a result, the balance as per the cash book and that of the bank statement would be different. 8. Errors committed in recording transactions by the firm. There may be certain errors from the firm's side, for example, omission or wrong recording of transactions relating to checks deposited, checks issued and wrong balancing, etc. In this case, there would be a difference between the balances as per cash book and as per bank statement. 9. Errors committed in recording transactions by the bank. Bank sometimes also commits errors, for example, omission or wrong recording of transactions relating to checks deposited, etc. As a result of this, the balance of the bank statement and bank column of the cash book would be different. Procedures of preparing bank reconciliation statement. The following procedure is used in preparing the bank reconciliation statement. 1. Compare the bank statement with the bank column of a cash book. Tick the number of similar transactions in both the bank statement and the bank column of the cash book. 2. The items that are not ticked in the bank statement are taken to the adjusted cash book. That opening balance would be the closing balance of the bank column of the cash book. 3. By the adjustment carried out in 2 above, you would arrive at a closing balance different from the balance in the bank column of the cash book. This new balance is called the adjusted cash book balance. 4. To the adjusted cash book balance, the UN presented checks are added and the UN credited checks are deducted. 5. The figure arrived at after the adjustment done in 4 above would be the same as the figure disclosed in the bank statement. It should be noted that everything is equal. The credit side of the bank column of a cash book would have the same content as the debit side of the column of a bank statement, and the debit side of the bank column of a cash book would disclose the same information as the credit column of a bank statement. Study Session 7. Capital and Revenue Expenditure. Introduction. Every business entity is required to maintain the accounts in a proper way as per the rules applicable. The wrong classification of the expenditure and revenue may have a great impact on the financial position and the financial performance/results of the business entity. In this study session, you will learn the meaning of expenditure and how it differs from expenses. You will examine the concepts of capital and revenue expenditure. You will also learn when we should classify expenditure as capital or revenue, the meaning of reserves, and how it differs from provisions. We will also examine the types of reserves and their purpose. Expenditure versus expenses. Expense is one of the elements of a financial statement, is the decrease or reduction in economic benefits during an accounting period in the form of outflows or depletions of assets, or incurrence of/increases in liabilities that result in a decrease in equity, other than decreases caused by distributions to owners. Expenditure refers to the cost incurred on the purchase of resources controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity, assets. Types of expenditures. We have 2 types of expenditures: capital and revenue expenditures. Capital expenditure. An accounting year is a period of 1 calendar year comprising 12 months. Whenever expenditures are made and their economic benefits span for more than 1 accounting period, such expenditures are termed capital expenditure. Most often, capital expenditures are usually substantial in their worth and should be charged to the statement of financial position except for the written-off part, which should be charged to the statement of profit and loss. Examples of capital expenditures include land and building, property, plant and equipment, motor vehicle. Revenue expenditure. This is used to refer to expenditures whose economic value is used up in 1 accounting period. They are usually needed for the operation and management of daily activities. They are commonly termed expenses. Examples include salaries and wages, electricity, repairs on assets, etc. Revenue expenditures are charged to the statement of profit and loss. Reserves and provisions. Over time, it has been observed that these 2 words have been erroneously used interchangeably. This ought not to be so, as they mean 2 different things. Looking at the similarity, they both refer to amounts set aside for a purpose. However, they differ in that reserves are appropriations from profit to meet certain obligations, while provisions are charges against profit to provide for certain obligations of uncertain worth. By appropriation, we mean that they are gotten after profit must have been determined. It also means that they represent distributions out of profit. By charges, we mean that provisions are first gotten before arriving at a profit. That is, they are reductions from profits. Types of reserves. Capital reserves are appropriations from profit or unrealized surplus for specific purposes. They are not available for distribution in the form of dividends. Revenue reserves are appropriations from the profit that may be used for future distributions to shareholders. Revenue reserve can be further broken down into general reserve and specific reserve. Types of provisions. With respect to provisions, an enterprise can be allowed to recognize a provision if, and only if, there is a present obligation, legal or constructive arising from a past event, the obligating event. Payment/settlement is probable, i.e. more likely than not, and the amount can be estimated reliably. Examples of provisions include provisions for discount, provisions for doubtful debt, and provisions for deprecation. General treatment for provisions. For the first-year treatment of provision, the amount is usually charged against profit as an expense while the provision is deducted from the asset value to which it relates in the balance sheet. For subsequent treatment, if it is an increase, the increment is a charge against profit as an expense while the new balance is deducted from the asset value to which it relates in the balance sheet. If it is a decrease, the decrement is added to profit as income while the new balance is still deducted from the asset value to which it relates in the balance sheet. Provision for discount. Before we examine the provision for discount, let us quickly look at a discount as a concept. In business, transactions are done either on a cash basis or an accrual basis. With respect to cash basis, tactics are employed to reduce the financial burden on the buyer as well as put a smile on the face of the seller. One of such tactics is by giving discounts. The practice of giving discounts, therefore, is a tactic employed by a seller to reduce the financial burden from the buyer. It is seen ultimately as a reduction in the invoice or face value of a transaction. We have different types of discounts. They include 1. Trade discount. 2. Bulk/quantity discount. 3. Cash discount. Provision for doubtful debt. These are debts on which the creditor is not sure as to the debtor's ability to pay. In such a situation, based on the prudency concepts, an estimate is to be made on the percentage of such debtors. The amount provided, just like provisions for discount, is to be deducted from the total value of debtors and charged against profit. Provision for doubtful debt is usually provided for after debts known to be irrecoverable have been written off. Treatment of this in the books is given below. Debit, profit and loss account. Credit, provision for doubtful debt account.